Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio. Our next guest is an old friend of the show, one of our returning regulars. He has the distinction of having been our very first guest way back in January of 2007 when he was still at Schwab. That show still gets downloads to this day, 3 years later, so he still has fans out there. Speaking, of course, about Tony McCormick, he obviously has a different title these days. He is the CEO of the Boston Options Exchange. Tony, welcome back to the show.
Great. Thanks, Mark. Appreciate the opportunity to come back.
Well, you're always welcome. You've been, I haven't counted it up, but you're not at the top. You're up there in terms of the number of repeat visits to the show these days.
Repeat offender.
Box people tend to do a lot of that. I think Scott Morris was on the top for a while there, too. He came on quite a bit. So we're very heavy on box these days. I'm not sure why that is.
Because you like to think inside the box.
There we go. That can be your new slogan for the exchange. Right. There we go. If you use that, I want a piece of that.
Okay.
But, let's kind of just dive right into it then.
Sure.
You've been around the space in a number of different capacities over the years and seen a lot of different things come and go. A couple of years ago, everyone was all in a hubbub about maker-taker. This is a new hot thing. This is going to take over the options business. And about a year ago, it seemed to have plateaued. We're at about 20% or so. And I actually, at this conference last year, I kind of did an informal survey on the show of all the different heads of the exchanges. And I asked them, where do you think maker-taker is going? Where's it going to settle out at? What percentage of the market? And the consensus was about 20%. And now, all of a sudden, this year, we're seeing maker-taker kind of on the flow side of that again. Where all of a sudden exchanges are taking it up. Box took up maker-taker, and you kind of step back from it a little bit. Philly now is adding a maker-taker to their traditional platform. ISE is starting to add it. I mean, everyone and their mother has some little some version of maker-taker going on. So first, I'm just, in a general sense, what's your opinion of everyone kind of diving into the maker-taker pool? And B, what's going on at Box with your maker-taker? You kind of had it, but you don't. And are you planning to step it up again, or what's the plan there?
Right. So it's kind of funny to see migration going to maker-taker
Yes.
since we basically moved away from that model and adopted the inverse taker-maker. So quite frankly, for us, the more people that move in that direction, the better, because it just empties out our space a little bit more. But, you're always going to have a real healthy balance, I think, between the two. I think the reason the migration is going on now is because in that world, in the penny world, spreads in these active names have become very tight, almost penny-wide markets.
Yes.
People said, well, it'll never be penny-wide even if we trade penny increments, but to the most part, it's in these names, it's getting there. And I think on the traditional side, it becomes very difficult to attract enough liquidity in that kind of a name, where you're paying for order flow and, basically providing liquidity, and you have obligation. So to help that situation and to keep that flow from the liquidity from moving away from those exchanges that need that deep liquidity, we're a retail-oriented exchange, so our liquidity needs aren't as great as somebody like, that has to handle the bigger orders. And quite frankly, a lot of the bigger orders are in those names. So to help that situation, I think the exchanges have figured out, hey, we're going to have to provide some support to that side of the marketplace, and we're going to have to pay, that liquidity provider for putting up that liquidity. And so I can understand that migration in that case, and it makes sense economically. We're not moving anywhere because, quite frankly, what we're trying to do is induce retail order flow. And so, retail flow would much rather be paid than pay. That's a given, right? Economics 101. And secondly, quite frankly, we have enough liquidity on the other side of those trades to meet the demand that we currently have. So we don't have that sort of liquidity need. And so you won't see us moving that direction. What we want to do in addition to that is we're trying to induce more price improvement. And we've created a mechanism within our PIP, our price improvement process, where inducement occurs anyway. We're going to pay for liquidity, or pay for order sending, the economic side of inducement, which is similar to PFOF at the other exchanges, only we do it in a fee-based orientation. And quite frankly, then we will also hopefully see trades go up better than the NBBO. So we'll see some improvement too. So the customer, his broker will get paid, which is good because there's economics involved in the value of the order flow. And secondly, the customer will see something good out of it because hopefully he'll get a penny or two of improvement. So we think it's a real good mix.
You mentioned the PIP, and I'm glad you brought that up because I'm always curious whenever I talk to you, what's going on with the PIP. Obviously, pennies kind of, for a while there, kind of defrayed the need for that kind of price improvement. You guys have done some upgrades and some changes to incentivize people to come back to the PIP. What's the status of the PIP? Is your percentage in that growing again, and what's going on there?
I think it's growing, and it's going to grow dramatically, and I'll speak to that in a second. But one thing to understand about pennies related to PIP it's not that the pennies obviated the need for PIP. What the hidden penny was the issue that basically eliminated potentially the need for PIP, because you could get inside the nickel spread with a hidden penny, and it served the purpose to the same extent as a price improved order would inside the nickel wide market. But the PIP itself for us, because we created the flexibility of the economics of the inducement in it in the penny names at 15 cents, that's what we allow in there, and then we created the availability between the sender and the initiator, so the liquidity side, to decide how to share that inducement. So the must be filled side, which is the order sender, can give all, none, or part of that inducement back to the initiator, the liquidity side. So it's kind of like you could selectively agree on instructions to us between the two parties about what level of price improvement you want your initiator to go to. In other words, if you want to be super aggressive, give back 100% of the inducement so he doesn't bear the cost of that. Secondly, what we've done is, and this is on the liquidity side, we created a facility for the initiator to use an order that's called a MIP, maximum improved price. Okay. And what the MIP does is basically allows them to stop themselves out in the iteration process. Rather than like on AIM at the SIBO, you go through a market iteration and you don't have that availability always to stop yourself out. In our world now, you can set a limit to how far you want to go so negative selection doesn't occur in terms of the profitability of the trade. So that's a good thing too. So the argument we made with the commission, which was prevailed at where other exchanges had tried it and didn't, we said, look, we understand on a single order by introducing a MIP, you're going to limit potentially the amount of price improvement that can happen, or at least from the initiator's point of view. So you could say, well, that's not so good. But the converse of that is, if you allow them to have that flexibility and availability of managing their risk better, they're going to improve a much bigger array of customer orders, because it's a tool that's effective for them, so they're not afraid of being negatively selected. So they'll do more price improvement in aggregate.
So are you seeing those percentages pick up of your order flow that are PIP and MIP?
Yes, definitely. And not to speak out of school a little bit, but
feel free. That's what this show is all about.
We are in the process of testing with a major order sender, a router, right now that wants to utilize MIP. And we hope that they will be up and running within a week or so. They're in the testing phase right now. And quite frankly, I think that will be a big, big amount of price improvement that will migrate over to Box, which obviously we're very happy about.
Yeah, I would imagine so. Now, like I said, you've been on different spaces of the industry for a long time. You've been kind of an observer of the space for a long time. We talked a little bit about maker-taker. Now that everyone's kind of picking up that model again and it seems to be flowing again, where do you think this is all going to shake out? Are we going to be looking at, a 50-50 world of options where half traditional, half maker-taker? Or are we going to hover? Last year, the consensus was about 20%. Mm-hmm. I kind of pulled all the exchange heads last year. Now it seems to definitely be on the upswing. So I'm curious, as someone who's been on multiple different sides of this business, what do you think this is going to shake out at?
Well, it's a very fluid environment. There's no doubt, and I'm always really reluctant to make predictions in an environment that's extremely fluid. But, it wouldn't surprise me to see that what you just said come to fruition, that, you could end up 50% of the market on one side, 50% on the other side. It's just because there's multiple participants in the marketplace that get served in a different way better by one side or the other, and that's where it'll fall out. So if you could tell me where big large orders, how much percentage of the market are they going to become overall? Are they going to is that really going to take off? And we know what names that's going to be in because we see it already. Then I'd say to you, yeah, you could be right. But quite frankly, I'll give you an example of the converse. Citi is a very active name.
Yes. Very active.
So in certain near the at the money's most active series of Citi, and we're obviously taker maker. On some days we do 35% of that market.
Really?
So that's sort of, if that was really totally the case, that's it doesn't explain it by virtue of what your market model is. So I don't think it's so dependent on your market model. It just depends on the dynamics of what's particularly going on and who your participants are. So I don't think you need to get caught up in it. There's the high frequency guys will tell you, maker taker is going to rule the world. They felt that for a long time. Now they're facing some issues, particularly on the regulatory side, that's going to slow down their participation. They're going to be tagged, and surveilled, and
like cattle.
Yeah, right. And there's going to be some issues around that for them. So. We're not in that arena per se. I have no fear that there's plenty of business that's going to be done on the other side of the equation, and so we're not going to be jumping around. I think it gets confusing when you we just redid our model, so I don't want to
You've had several models, I think, since I've talked to you.
Now we have the right model,
okay.
and quite frankly, the same thing with fees. We're not jockeying that around too much. There's a lot of movement on that side about, with the cap now coming out, and you a certain point you become like the airlines. Well, your bags are free. Oh, we charge you for bags. Oh, you're going to have to pay for take-on bags.
Yeah, it gets a little
crazy after a while.
Now, you mentioned new participants in the space, and we also obviously have new players in the space. BATS just came online a few months ago, and I'm curious, as you look at them and where they're carving their niche out in the option space, do you see a space for them? Do you think overall they are additive to the business, or are they kind of coming in and cherry-picking order flow, and they're kind of cannibalizing existing business?
I quite frankly see them more as a free rider of the current environment because, they have some strong participation on their ownership side that, handles flow, and they're doing nothing other than replicating, really pretty much what goes on in the electronic make-take world. They're going to carve out their niche. I have no doubt of that. I heard Jeremy say that they can break even on 200,000 contracts, and they're already doing 50,000 on a good day. So they're going to be around.
Yeah, the cost of entry is pretty low.
Pretty low cost of entry.
Makes it easy for them to pay off. I
don't see what they really brought to the marketplace so far. I have respect for them because I've seen what they've done in the equity space, but it is what it is. That's another reason I didn't really want to be on that side of the market, because that's the easiest point of entry. And the first thing they did is they came in and they chopped the exchange, basically revenue side in half. So they're selling price basically.
Yes.
Whenever you don't have a differentiator, what do? You sell price. It's a race to zero. So
that's kind of what I asked them on the other day. I asked what were their two main value addeds, and they mentioned the ownership model, obviously, which we can get into, and also pricing. And I even said to them, I said, pricing is interesting, but there are other people out there with deeper pockets than that. So people could easily match that, and it isn't a long-term value added. But I want to get back to what you mentioned, too, about the free riding. I've had a lot of different exchange heads on here. We'll have more on here. And there's been a lot of pushback, as there was with NASDAQ when they came on, too, about the cherry-picking stuff. Would you be in support of some sort of even regulatory enforced minimum quoting requirement for new entrants into the space, where people have to not just come in and list front-month at-the-money Google, but also maybe some of the deeps and some of these less liquid names that are just taking up bandwidth for the most part?
Well, I'm a big believer in free competition, so it's hard for me to ever endorse the idea of, regulatory hurdles. I think we have quite a few of those already in our marketplace.
That's true.
But by the same token, I understand what built the business, and I understand from the retail side the value in what was called at one time the WYSIWYG. What you see is what you get, and customers have come to rely on the fact that when they want to trade something and they point and click on it, that the liquidity is there, in at least a sufficient amount of liquidity, 20-lot type liquidity, and there has to be obligation to do that, and opportunity. It's goes hand in hand. So you have to balance those things so that the liquidity side can exist. And if you let cherry picking go on and you let people to come in that don't have obligation and let them trade the best stuff, basically, and not provide liquidity anywhere else in the whole overall structure of the business, then you're hurting the business. You're changing the business. And, maybe the business will migrate totally to, just a bulletin board type environment where you come in and you post something and it'll all be market limit orders, and limits will hit limits, and, that whole obligation entitlement game will go away. But that's not what built the business, particularly the retail side of the business.
It's kind of funny now to think of Box as one of the old hands in the options business, but you're getting there. You're like 3 deep now, so there's been a couple entrants after you. And I'm curious, as one of the more established exchanges now, I haven't been around, about 5 years or more, how do you defend yourself against these little encroachments that keep nipping at the heels and taking away a little bit of percentage and offering things like the pricing availability and kind of carving out little things for price? And, where's obviously you have the PIP and the MIP to improve with, but how do you keep defending against a little 0.5% here and 0.5% here? Eventually these things add up. These people can carve away enough. Yeah. Look at ISC. They've taken a big hit from this stuff lately.
The good news, I guess, is the pie's still growing. So that being said, you can see share being carved up and still peacefully or profitably coexist with more competitors. But by the same token, I agree with you. At some point, particularly for the bigger exchanges, to get chiseled here, chiseled there, we're building share at Box. We have a relatively low share. I think we will get back up to high single-digit share. Maybe 10% would be a good target. But the good news for us is I look at it as a value equation. And the value equation in my mind is, first of all, our orientation has to be retail. We don't have sufficient liquidity to handle those big orders. We don't have the throughput technologically.
Box isn't an institutionally oriented player.
Not at all. But by the same token, there's plenty of retail available order flow, and it's still growing. And secondly, I think the migration of retail flow to the take-make side, it's not going to go make take. We know that, right? The economic model doesn't work that way. Secondly, I think they talked today the commission talked about in their presentation Rule 605 migrating into the equity options world. That will be very good for price improvers like us, because there will be a dissemination of the quality of market and the execution and how much price improvement is available. And the broker-dealers will start competing on that basis. And to do that, they're going to have to basically use price improvement mechanisms. And the best ones, the most transparent, the most flexible, is the one we have, PIP. And I'm confident that we will see more and more retail flow come in and get price improved. And it may at some point be a third or 40% of the market will be involved in doing price improvement. That's a huge amount of business. So I think we're in the right place. That's why I positioned us in the position we're in. Strategically, I think it makes sense. We don't have to address things like the cap. It doesn't mean anything to me. We'll compete. We have enough liquidity to compete for the type of flow we're going to see. And we've created the model that works for that environment. And quite frankly, we don't have anybody to subsidize us. We're not subsidized by some other part of a business, exchange business model that maybe makes a lot more money and then basically tries to steal share in the operating in the environment of options just for the point of getting share and then hoping they make money on it someday. Because I don't think a lot of these exchanges are making any money where they're pricing things, because they're not, they're putting stuff up for free basically.
For some of these changes, definitely. I think we'll get into one of those in a minute. But, we mentioned before, like models and different approaches to this and different ownership models. Everyone's kind of aping the old Philly model, sell off pieces of your exchange, it'll bring you business. If you talk to Bats, that's one of their major competitive things going forward. They're selling off pieces of their exchange to bring flow. Amex is obviously doing the exact same thing. And obviously Box has a majority owner already, but is there some talk over there? If this model continues to become prevalent, are you looking at following suit and having some more investors come over to Box?
Yes, we are definitely in the process of looking at that strategically and what that might mean. But there's a given in there that, is the critical given. And the given is, it doesn't matter if you allow people to participate and you incent them, through an ownership structure. The end game has to be that there's value created in the process. And, so in other words, the piper has to get paid somewhere. So, you can make promises and you can set up schemes, but it only works if overall the thing becomes a profitable, ongoing enterprise. And, the way I see some of these things happening recently is that it looks like to me people are coming in and they're committing to it, but the bottom line is down the road, what is the value? If you're doing it, if you're putting up share for basically nothing and your operating income is very low, the end game isn't very good. Who cares if you own part of it, right? It's not profitable. It doesn't make money. What's the end game? Who are you going to sell it to? And I think that's the thing you got to keep an eye on here is where do the investors who are doing this and participating, where do they get out and how do they get out? And what is the value that was created along the way?
Interesting, too, about that is that, as everyone pursues this model, there's a finite number of large liquidity providers. There's a finite number of large order flow providers in this space. If everyone is pursuing them, eventually the same people are going to be owning pieces of all the same exchanges. And you're kind of back to square one again, where the first mover advantage of having been the guy who sold his first piece is gone. And so I think the marginal value of that model is decreasing with every single exchange that goes that way.
Totally agree with that. I mean, we had a situation where exchanges went through a process to demutualize, because they started that. And
now they're going the other way.
Now they're remutualizing, right? Yeah, exactly. So, I'm not interested in playing that game unless I can figure out a way that it adds value to the whole thing and to my current shareholders. And, that's why I think it's really important to pick the place you want to be in the market, figure out how you add value, how you can make an economic return on it. And if you can do that, the rest of it will sort of take care of itself. Shareholders will, come and go. And quite frankly, it'll depend on how much dividends you pay them and what kind of return you give them. And, to try and figure out a game that would somehow in the short run create something for you, but the end game it doesn't bring anything of value to the participants, I just don't see how that works.
When you're talking about all this non-economic value trading, I assume there's one exchange in particular that you're probably thinking of most of, which would obviously be Philex doing a lot of these exploitive dividend-type trades. And so I'm curious, as someone who's been around the block a while, what your opinion of this kind of stuff is. But at the same token, if these guys are putting it up and it's distorting share, you have to play in the same field. So are you kind of going after these same non-economic but volume-boosting trades?
No, not interested in that at all, to be honest with you. I think people will ultimately see through that. The ISE has basically put out some proposals that, that should be filtered out of market share numbers. By the same token, I'm not against it. It's been around for a long time. There is risk in it. I made a comment this morning on the panel that, on the dividend capture game recently, I had a very sophisticated hedge fund basically got caught on a bad dividend capture, and it cost them $250,000, and they actually shut the program down. So it's not going to go away, I don't think. I don't think you really need to legislate or regulate against it. I think investors, as they become more and more savvy, will understand that they need to roll out of things near a dividend, and brokers can do some good there by basically noticing them, either electronically or otherwise, that, hey, you want to be careful of this position. You might get captured in this. Your dividend may be taken away from you, et cetera. To me, I mean, I know it goes on. I don't think it's really market share, so I don't really get caught up in it. But I don't think it's going away either.
One of the reasons we bring it up a lot is obviously there are various points of view on it, and it has been around forever. I used to see them all the time when I was on the SIBO. Obviously, they're much smaller than you probably do, a few thousand contracts here, not in the millions that we're seeing today. But there are other impacts of this, and this kind of gets into what you were saying, too, about just the volume numbers, and maybe there should be more granularity in some of the numbers we're putting out to the end user. Because we see on our site, we work with a variety of different options users, basic retail, high-end retail, institutional, all gradients in between. And we're constantly getting questions. The dividend trades are a good example. They're starting to learn about options. They're starting to follow options volume and open interest as a way to be indicators for the underlying. And all of a sudden, they see some massive spike, and they contact us saying, hey, what is going on in this? Why is this happening? And so, and selfishly, it's kind of good for us because we get a lot of traffic out of it. But at the same time, it's obviously distortive, and it obviously is confusing to the end user. And that's a negative experience for the retail customer. And that's just one example. In addition to losing the dividend for people who aren't savvy enough to exercise that. So there's multiple downsides to this. Not just the dividend trades, but just in general. I think it's illustrative of just, we're kind of pushing out a fire hose at the end user right now in terms of and overall volume data. It's like, here you go. Here's this massive amount of volume. It contains everything, but it's not very end user friendly. I mean, dividend trades obviously should be pulled out, but there's other types of volume in there. I mean, there's volume numbers that are counted multiple times as they're routed to different exchanges. There's big cross orders that may or may not represent economic trades in there. We can maybe delineate those. There's a lot of more granularity I think we can get to that, to not just make it for, for the high-end institutional guy, but even for, your mom and pop retail and your high-end retail who are getting more active in this space. I mean, I've kind of been asking each of the heads of the exchanges, if they would support more granularity in what they put out. Obviously, there's voluntary best X going on right now, and that's a good first step. But there's a lot more that can be done, I think, in terms of really making these volume numbers useful for the end user.
I would agree with that, and I'm supportive of that. I think you want to take the noise out as much as possible. People do look at volume as information, and trade off of that based on, and if it's disseminated in a way that's either, like you say, opaque or misleading, it's definitely not a good thing. So, I'm fully supportive of that. We're not putting up those kind of trades. So I guess if you want to look at it, our information is cleaner in that respect. We don't have a lot of noise in our market, so it's pretty pure. And whatever can be done to sort of replicate that elsewhere, I'm totally in favor of.
And most of the heads of the exchanges have been. The guys from NASDAQ, OMX, Philex were a little less receptive to it, as you might imagine, but they do a lot more of that volume.
Well, that hits a little close to home there.
Now, let's talk a little bit about what you have going on at Box. The last time I spoke with you, and actually with even Will at this conference a year ago, there was a big push on the horizon for your crossing platform, your crossing network, and there was some question about what you're going to do with that and where you're going to start competing with guys like Ballista. What's the status of that, and how is that shaping up?
Okay, so to be quite frank, that's something on the priority list that I downgraded when I came last fall. And the reason is I didn't see it supportive in terms of the things I needed to do to deliver on the strategy, the retail strategy and the price improvement strategy that I wanted to deploy. So I had to shuffle that deck a little bit. And at the same time, we had a big project going, and which will launch May 10th. We're converting to Equinix in New York, our data processing plant and connectivity. And that's going to be a huge uptick for us in terms of speed, capacity, all the kind of things that, users want, particularly on the liquidity side, need. So that was a high priority for us. And then I prioritized some changes to the price improvement process. So I had to push out something because something had to give. And that was one of the things that had to give. We're still going to do it. And I think it's important for us, but it didn't reach the level of on my radar where these other things were.
We certainly got a lot of questions after that episode aired from people contacting us saying, what is Box doing? I mean, that got probably as much as anything else we covered last year at the OIC, that got probably as much feedback as anything else. People were really surprised. I asked Will point blank, I said, is this a competitor to like a Ballista? And he said, yes, probably. So that surprised a lot of people that an exchange would be going in that direction. So it makes sense. I think that would be downgraded in priority while Box has some other things to take care of first. And speaking of some other things, I heard you were quite the rabble-rouser this morning on the Exchange Leaders panel. I heard you had some interesting points of view on what's going on out there in Washington these days. And you were. It was funny. We just had Susan Milligan from the OIC on here, and she expressed a very rosy outlook actually for what's going to happen. I hear you're a little bit more on the dark side of the spectrum.
Well, I guess I'm guilty of being very outspoken. I don't have that good filter, that edit button.
That's why we like having you on, Tony.
Probably should have.
Feel free to unfilter away.
So, I look at something and I don't like to basically sugarcoat it, and I'll express what I think about it. And some of the things I'm seeing, I'm a little concerned by. So I wouldn't say things are rosy by any means. I have a particular axe to grind, and I don't think it's going to be an issue, but I want to make sure it isn't with the commission because you never quite know where they come out on things. But this whole issue about flash exposure. Flash exposure is not in any way, shape, or form in options the same as it is in equities. There are some issues around how widely disseminated that exposure might be, whether there's an economic inducement that also occurs to make the step up occur. I could say I might have some issues with that, but overall, I don't think it's anything that's nefarious or bad. It basically, all it does is it allows customer orders to be, and when routed to some of the traditional exchanges, be treated in a way that it doesn't force that order to go to another market. So if the way market in certain case might be better or tighter, and an order comes into the traditional market, there's a very brief exposure to the traditional market participants on the liquidity side that says this order needs to be stepped up and matched or routed away. It's very high probability that it'll get matched. And, so from the standpoint of the customer, that eliminates the cost of going away and paying, the maker fee. And the taker pays on that side, and whereas on their side, the PFOF is what we would consider the taker incentive. We do it on a fee basis. So I'm supportive of that. But even more importantly, I think the SEC understands this because they've written some of it in their footnotes. At all costs, the exposure process in a price improvement mechanism or a price improvement process, as we call it, PIP, should be protected. You have a stopped order on price looking for potential improvement. So it's stopped at the NBBO. There's no reason to have an issue with that. And what you're doing when that iteration of milliseconds is to find additional price improvement by liquidity side.
Now, it's interesting you should bring that up because I know last year at the FIA OIC show in New York, Elizabeth King on the SEC was asked specifically that question. They said, is this flash ban in equities going to be applied to options? And most people thought she would instantly say no. And she actually kind of thought for a minute before she answered. And her answer was kind of very opaque in that she was like, well, that very well might be. And I think that took a lot of people in the room aback. And I was certainly surprised by that. Well, of course, lately that seemed to have downplayed that. In fact, I talked to Gary Katzup, I think it was a couple months ago, and I asked him that specific question. I said, are you still concerned about the flash ban being adapted to price improvement auction? He said, no, that's completely off the table. That has been removed from all the filing. So I'm kind of interested to hear that you're still concerned about these. You think they still haven't taken it off the table completely? My
concern is a result of what I heard this morning and the remarks made by the commission. They basically said that they're still looking at the whole exposure thing. And quite frankly, part of that is related to the fact they put in the cap on the other side, the 30 cent. And some of the argument before was that without allowing exposure, you'd have an unlevel playing field and cap would have an advantage. Now with cap, that side has been fixed. So people say, well, now they're going to come back and look at exposure and say, why do you need exposure as long as we've capped that off? So that's still in flux. You could tell by the position they gave out today. I specifically asked the question in the question period, what about in price improvement? And I got a very sort of amorphous kind of, that price improvement is good kind of answer, which, didn't really define anything for me.
They seem to have gone both ways on that issue in the past 6 months or so.
So I said on the panel afterward, our panel, the Exchange Leaders panel, I said, I will defend to the death the opportunity for customers to get price improvement, because it's really important. It's really good for customers. It makes total sense. And the fact that it's facilitated by an exposure process, so what? That's a technological utility.
You'd think the end user benefit would be kind of obvious to them.
Totally.
But essentially, since their mandate is retail protection at all costs, I mean, if they're getting improvement, I think that would be a relatively easy sell, and yet they seem to be hemming and hawing on that a lot, which is kind of surprising.
I think it will prevail that way, but I'm going to be beating the drum really hard on it. So
you need to get a place down in Washington next to Brodsky, and the two of you can.
He's the dean. We all follow behind the dean. Can't even begin to have the level of understanding he has about that.
Well, Tony, that's about all I have for you today, unless there's something else that you would like to add.
I really enjoyed catching up with you and love doing your show.
It's always fun to have you back on. And feel free to be as outspoken as you like in any of your appearances. We love it.
My internal lawyers didn't say that, but I'm glad you do. All right, thanks.
All right, Greg, Tony, good having you again.
And that's going to do it for this episode of Options Insider Radio. Be sure to visit www.theoptionsinsider.com for more episodes of this program, as well as breaking news from the options market, the latest articles and analysis from options experts, a wide variety of options education, and of course our discussion center where you can share your questions, comments, and insights with your fellow Options Insider users. While you're there, be sure to register for our monthly email newsletter, as well as our free email alert system. Our email alert system makes it even easier to stay up to date on the latest content from theoptionsinsider.com. Thanks again for listening. My name is Mark Longo, and I'll see you next time on Options Insider Radio.
Options Insider Radio was created by Mark Longo and produced by Gene Crotty. Options Insider Radio is a production of the Options Insider Incorporated, all rights reserved.